Selling your home can bring big financial gains, but it can also bring a big tax bill if you're not prepared. How do you avoid costly surprises and make the most of your equity? In the next episode of How to Sell Your Atlanta Home with Sage and Grace, Smart Homeowner Strategies, Successful Real Estate Sales, we're talking with a seasoned tax strategist about the smart moves Atlanta homeowners should consider before they sell their home. Today's guest is Alysha Harvey, the founder and CEO of Distinct Tax Consulting Group. As a leading tax strategist, accounting expert, and business consultant, Alysha helps individuals and business owners navigate complex tax situations with clarity and confidence. She's also the best-selling author of 3 books on tax management. Alysha is here to share what every homeowner should understand, take into consideration, and plan regarding taxes when it's time to sell their home, so homeowners can make smart, informed decisions and avoid costly surprises. Selling a home isn't just about putting up a for sale sign. It's about strategy, marketing, and negotiation. But how do you know if you're making the right moves? I'm Judy Jernigan, recognized among the top 5% by the Atlanta Realtors, and your host of How to Sell Your Atlanta Home with Sage and Grace, Smart Homeowner Strategies, Successful Real Estate Sales. With a background in broadcasting, negotiation, and education, I bring a unique perspective to home sales, helping homeowners sell faster, for top dollar, and with less hassle, while understanding not just the financial side, but also the logistical and emotional considerations of a move. This show helps you plan ahead, navigate the market, and work more effectively with a realtor like me. You'll get expert insights from my guests, plus real actionable strategies to sell with confidence. Now, here's the show, moving you forward with sage advice and grace. So thank you for being here.
Awesome. Thank you for having me.
Let's talk about tax basics for people getting ready to sell their home. So what is the biggest considerations that people who are getting ready to list and sell their home need to be thinking about?
Yeah. So I always tell my clients, we need to understand how much debt we have. We also need to understand our cash flow, right? Because we need a down payment. And sometimes it's not an easy answer. If your business is cash flowing, or if your personal is cash flowing, right? We have money in the bank after we pay our bills.
So this is for helping them prepare to buy their next home.
Correct.
Gotcha.
Yeah. And so we have to look at how we're handling our finances today so that we can get the best approval rate with the mortgage officer. But then also getting us to a point of making sure we're compliant on our taxes, right? We need those tax returns in order to get approval. And so I have several people who come to us and say, hey, I want to buy a home, but I haven't filed my taxes in 3 years.
I've run into that too. It's a really, really big hurdle.
It's a huge thing. And even some of I think it's simple, but most people don't know. There's I can't get my transcripts, right? And so we can get transcripts usually within 5 minutes. Right. And so just having access to those different financial pieces before we get to the mortgage loan officer, right? Because you may have already have your realtor, identifying where are those gaps financially that's going to prevent me from getting to that next home.
Can you walk us through capital gains taxes? I feel like that's a big consideration when someone does sell a home.
Yeah.
Let's start at the beginning. What are capital gains taxes?
Yeah, so capital gains in layman's terms is the tax that we have to pay on something we owned that we sold, right? Because the government wants their piece too. Now, if we're selling our primary residence that we've lived in for at least 2 years of the last 3 years that we've owned it, then we don't have capital gains on the first $250,000 if we're single, $500,000 if we're married. Right. But if we're landlords, well, there's capital gains regardless, unless we take that strategy and say, hey, I'm going to go back and live in that home for the next 2 years before I sell it. And so that could be a great strategy to eliminate the capital gains. Now, capital gains tax can go up to
those amounts. Okay.
Correct.
So $500,000 if you're married. So and that's your Not your sales price, but the gain amount.
Correct.
Okay.
So if we take the sales price of how much we bought it for, how much we're going to sell it, that difference, if it's 250 or less or 500 or less, depending on your filing status, then we're exempt from capital gains. Now, if it's more, it's the difference between that 250 or 500 and what the total net sale of that home is. So I always tell people, before we start selling that home, we have to think about, are we going to run into capital gains, right? Majority of homeowners, the answer is no, we're not going to have it. But if you've been leasing any part of that home out for profit, then we have to have a deeper conversation and then think about, okay, however much is left after the sale of this home that they wire back to you or they send you a check, however it runs, we have to put money aside. And we don't create a tax burden later that puts us in risk of losing our home because of liens and levies.
Right. We don't want that.
Yeah.
So how do capital improvements come into play?
Yeah. So those capital improvements from a personal standpoint does not change like tax wise or accounting wise for you, but it can help with the sale of the home in the future with things like, maybe the kitchen, the bathroom.
Can you help me explain to people what capital improvements are?
Sure. So those are what I look at as the large items within the home, right? That make a big difference, that stand out. So those capital improvements could be within the kitchen.
So an investment you've made, an upgrade.
Correct.
Not a repair, is that right? But
correct. Not a repair. We're talking about a replacement, something new. So we take out old cabinets, we take out old countertops, or maybe even old appliances and say, hey, maybe I might even knock down a wall or two or put up a wall or two. Those are capital improvements.
So save the receipts from that word.
Always save them, right? So if we own that home in particular, it's not going to necessarily make a difference. But if we lease it out, that makes a huge difference. We need to keep those receipts so we can write it off. But then we also want to keep those receipts for anyone who's like short-term, long-term landlords in terms of flipping homes or whatnot. Mm-hmm. Those make a huge difference when we go to flip those homes.
So I think most people, the majority of people, live in their home. Let's say they're married. Mm-hmm. When they're ready to move, we sell the home. Any gains or profit between what they paid many years ago and what they sell it for now, help me with the math. If you did a kitchen remodel, I'm going to say $20,000. Is it like 1-to-1? You subtract that from
Absolutely
your gains?
It is. Yes. So we would take, let's say we bought the home for $500,000 and we did capital improvements of $100,000. And then we go and sell the home, let's say for $1.1 million, right? So the initial capital gains difference, so we have 500,000 minus 1.1 million. That gives us 600,000, right? 500,000 is already exempt because we're married. That leaves us 100,000, but we did 100,000 of improvements to help us get to that 1.1 million. So then at that point, we can then eliminate, I would say, majority of the capital gains because there's depreciation, right? So we spent 100,000, but
that's where it gets complicated.
Right, that's where it gets a little complicated. So even though we have 100,000 and it is 1-to-1, but we also on the back end, we have to consider that if we made that improvement today, but then sold the home 2-3 years later, it's technically not worth, from a fair value standpoint, 100,000. So there's a small difference, not huge, but a small difference. Okay.
So more examples of what counts as I do get this question frequently, mm-hmm. what counts as a capital improvement? So the roof got old, was leaking, you put on a new roof.
Correct. So you have your roof. If there's major landscaping like sprinkler systems, right?
Like installing a new sprinkler system?
Correct.
Not repairing one that's...
Not repairing. Okay. Always replacement. Redoing an entire kitchen, bathroom.
Okay.
Those are huge ones.
Mm-hmm.
For some people, if you're pulling the carpet out throughout the entire home to put hardwood, that's a major improvement and a capital improvement. If we are, I'm going to just throw this out here, but painting is not a capital improvement. right? That's more of cosmetics,
Yeah, that's a good example.
right?
Okay.
But if we're putting
Certainly an
up shutters,
investment that I would still suggest you consider, but not a
absolutely.
capital improvement for tax purposes.
Not a capital improvement. It definitely can help sell. Shutters, gutters can be capital improvements.
Okay, like if you do like the really nice upgraded gutter guards type
Correct.
things. Okay, but just having someone come and clean your gutters, not so much.
Correct. Yeah. And I would say most recently we've had people install bunkers, right? So the underground bunkers, those are capital improvements.
Oh, wow. All right.
Yeah, because that adds to the value of the home. It's like also an extension.
Oh, or what type of documentation should people keep?
Yeah, so everything that you purchase. So if we're going to Home Depot, Lowe's, or we hired a contractor, have that contractor break out the difference between labor and materials,
Okay.
right? And so there should be ideally an itemized receipt that shows they bought nails, they bought wood, they purchased concrete, or granite countertops, whatever on the cabinets, whatever type of fridge and microwave, all those different things for that new kitchen, or that entire breakdown of that bathroom from the toilet to the tub to the shower to the sinks, everything. Even the heated floors, all the heating elements, have them break all of that out. And in an ideal world, we'll see the material and what labor goes with that. But in most cases, we'll have the materials broken out and the labor at the bottom. And that's okay too.
Is labor count, or does it need to be?
Labor is also included in that.
But you just like to see it itemized.
We like to see it broken out. From a long story short, but we can ultimately allocate that labor across multiple invoices. So if the contractor purchased all these things and then you went out and purchased other items, we can allocate some of that labor to those other items that you had.
So we are seeing more and more people have short-term rentals like an Airbnb or travelnurses.com is common and near where all the medical centers are in Atlanta. So if someone is renting out a room or an in-law suite, or maybe they have an ADU in the backyard, how is that? And then they go to sell the home. Is that going to impact their taxes?
Yeah, man, it could be a good thing, but it could be scary because we've now complicated our $250,000 to $500,000 capital gain exclusion, right? We've now complicated that because a portion of our square footage has been leased out, right? So now we have to do what we call an allocation of square footage that is considered personal and what is considered that's rented out. And the parts that's rented out is not excluded from capital gains.
Okay.
So now we have to look at that and say, I'm just going to throw a number. 1/3 of the home is rented out and 2/3 is personal. Okay. So when we go to sell that home for easy math, $100,000, well, 1/3 of that, say $33,000, is now subject to capital gains because that was rented out.
Okay. And it wasn't like your primary residence. So
correct.
It doesn't fall under the exclusion we
correct.
talked about earlier.
Yep.
That makes sense.
Yep. And then the other 2/3 can qualify for that exclusion.
Great.
Yeah.
All right. So what if a homeowner has to move due to a job relocation or a divorce? Are there any exceptions or benefits they should know about?
Once upon a time it was, but now the only people who get moving incentives or deductions or any type of benefit are usually your politicians or your military. So, and now most of the military is already covering you. So there's not much there unless you're paying for something out of pocket outside of the military that you did not get reimbursed for. So there's not much anymore. I hate to say it.
How do taxes work when a property is inherited and then sold?
So initially with anything that's inherited, it gets what we call an automatic step up in basis. Layman's terms, your parents, let's just assume parents or grandparents bought that home for $100,000. It's now worth $500,000. They pass away. You inherited that after the date of death. Then what we call the step up in basis, at the date of death, it was valued at $500,000. That is now your basis. So when you go to sell the home and you sold it for $500,000, you know what your capital gains are? Zero.
Okay, good.
So the great thing on the inheritance, as long as it's done properly, you don't want to start changing things before the official date of death. And I know that's one of those things that we're urging to do. Like, oh, go and move this, change the house into my name, go and give me access to the bank account. We have to wait that out.
Oh.
You have to wait it out. And I've seen too many times where people do all the work before date of death and they know they're on their deathbed and they're like, okay, we moved everything around. And I'm like, no, this creates a problem. It creates a taxable event. And at that point, hearts are broken. People are pissed. And they're like, well, what if we don't report it? I'm like, I'm not here for that. So we already know what happened. So we got to report
I
it.
didn't know that. So wait.
Yeah, please wait. And there's ways, when you're working with a tax strategist such as myself, and you're working with an estate attorney, because we pretty much are like married in your situation. And you need the both of us in order to create a plan to not do stuff like that. And so it makes it easier at date of death, because that's probably like some really hard stuff to deal with. Because the person died, you have a funeral, now they have all their assets or however few assets they have. Now you have to go to probate court because you didn't have all the proper documentation. And going to probate sometimes sucks up the value of the assets that you have.
So when we say wait it out, we're not saying don't plan ahead, because
Correct.
there are steps you can take to plan ahead. You just need to make sure you're taking the right steps.
Correct. Yeah.
For sure. Is it ever a good idea to wait until the next tax year to close on the sale of a home? Is there ever a reason to do that?
Absolutely. So when I have most of my senior citizens or my executives, right, who may be getting to a retirement stage in their life. And so they're at a level where they're making quite a bit of money. And so we know that they're going to have capital gains at that sale. But their income is going to decline the next year. So now when we look at how much in capital gains plus their tax bracket, we're at a lower tax rate and a lower tax bracket the next year. So it's usually best if we can wait at that point. The other thing is some people sometimes lose their jobs and they're trying to find ways to get more money in their pockets. And so their answer is, let me sell my home. Well, you just lost your job this year. So if we calculate how much money you've made, then the sale of the home, if it creates a capital gain situation, it may be best to wait till next year, right? Because you may or may not have that same job. So your level of income really does help determine that. And sometimes for people who may be having children, or now you're taking care of a sibling, a parent, or a child, sometimes that helps the situation when we're looking at different credits to apply to your tax return, because we're looking at overall, not just the capital gain possible, but we're looking at your tax rates, your tax brackets, all of those things.
When should a homeowner who is about to sell a home, when should they reach out to a tax advisor? Like before they're ready to sell, while it's listed, once it goes under contract? At what point, at what stage in the game would you suggest them reaching out?
I always recommend at the moment you think about selling.
The sooner the better. Right?
Yes. If it's unfortunately at that point where it's like, hey, we have an offer, we're about to close. Well, now at this point, you've already signed the offer, we're about to close. You have a date. At some point, we have to think about, now it's just a matter of just preparing for whatever that tax bill is going to look like. There's no prevention, really. It's just more of, let me mitigate a little bit. There's a few things you can do to help the situation. Usually it's like one handful at that point. But we have two handfuls, maybe even your 10 toes that you have, right? When you call us and say, hey, I'm thinking about selling my home in the next year or two. What can I do? What should I do? At that point, we have plenty of time, because now you also have to look for a home. You have to get pre-approval. You have to get your home ready. We have to get your finances together so that you are a full ready package to get to the closing table.
Yes, so the sooner the better. Same with, call me when you're thinking, just even thinking about selling your home or making a move. Like the sooner we can start planning ahead, the better. People will be like, oh, no, we're just not thinking about it. We don't even know this or that. I'm like, that is the perfect time to call me. Don't wait. I'd rather be involved from the very beginning, even if we're talking a year or two or more.
Yeah. The sooner the better.
Do you have any anecdotes of working with home sellers, some stories, or major red flags or situations where a home seller definitely needs professional tax advice? something weird.
Yeah. So, man, about 2 years ago, I had a client, knock on wood, they're no longer a client anymore, but they said, hey, I inherited this home from my father, and we had tenants, but we don't have the tenants anymore. We're ready to sell it. We don't want to pay the property taxes anymore. And I said, okay, great. So give me the story, the backstory. Well, we go to the county website, no data on what the sales price was, right? So the child, my client, inherited that property, but guess what? Even at date of death, there's no value. So, and he also did not do the appraisal or anything at date of death because we don't have any data at all. Data started probably about 5 to 6 years ago when they switched it over to their name, and the county then started reconciling how much the property was valued at. So I told the client, I said, hey, unless you have someone that you'll have to hire someone, and here's someone that you can call. I can't tell you how much it's going to cost. They'll tell you. But they need to go back and figure out what was the value of this home from 15 years ago. And then figure out what was the value of what your father purchased it for. He never did it. So then I said, well, in an ideal world for this situation, based on what we know, we need to do a 1031 exchange because they're in the business of real estate. And so they buy, they flip, they lease out, they rent. And I said, hey, we don't want to pay capital gains on this because we don't know the history because you didn't do the work you were supposed to do. And so now at this point, we can only base it off of he bought it, he received it free, it was zero. And what you're going to sell it at, that's all we have. And I know you don't want to pay capital gains on that. And that property was worth maybe about 600 and something thousand. Wow. Well, I said, hey, this is what we need to do. We need to go and contact the 1031 exchange attorney. We need to go through the process. He said, okay, great. I'm going to let you know when we're ready to move forward. Cool. Well, Judy, fast forward 6 months. And he said, hey, okay, I sold the home. So how can we do the 1031 exchange? It's too late.
It's too late. Yeah.
It's too late. Sir, we have $600,000 of capital gains. Him and his wife were pissed. You can imagine the conversation when they hung up.
So the main thing I know about a 1031 tax exchange is we need to get you and the lender that's involved early, right?
Absolutely. Yeah. Because you have to identify 3 properties. And then you only have, I think it's like 30, 45 days from the time that you sell the first home to get the next one or the like kind exchange. But you have to identify those in the beginning. And when you sell that first property, you can't take the profits from that to your bank account. It has to go through an escrow process. And only the 1031 exchange attorney can do all of that. So you go through that 1031 exchange process, then we go buy the home. And then once we buy the home, then we can get to the point of where you can get whatever cash is left and we can exclude those capital gains. But yeah, so, that whole debacle ended our business relationship because they were like, you created this tax bill for me. I didn't do anything.
All we can do is advise and educate, and ultimately it's up to them.
Yeah, I can't make the decisions for you.
I feel like the theme today is consult with us early and often, right? Be it your real estate professional like me, when you're thinking about selling a home, it's not too early to start the conversation about some of the things you should be thinking about and doing, even if you're planning ahead. Your tax advisor, get with them early so that you can start planning ahead, and we will point you towards other people you may want to talk with, like an estate planner, such as a mortgage lender, so that we all can it's about assembling your team and making sure you're taking the right steps. And the sooner we can do that, the better, right?
Agreed. Totally agree.
Where can people find you? Absolutely.
So TaxAdvizHER on all social media platforms, and that's TaxAdvizHER.
TaxAdvizHER. And your website?
Yes, distincttax.com.
Awesome. Thank you for being here.
Thank you for having me.
Thanks for joining us on How to Sell Your Atlanta Home with Sage and Grace. I'm Judy Jernigan, and I love helping homeowners sell smarter with less stress and better results. Who do you know with real estate questions? Please connect us so we can make confident, well-informed decisions and get the best possible outcomes together. If you enjoyed this episode, be sure to like, subscribe, and leave a 5-star review. It helps more homeowners get the smart strategies they need for a successful sale. Head to sageandgracere.com to learn more about working with me and the Sage and Grace real estate team. Explore all our show episodes, and when you're ready, book a chat directly with me, Judy Jernigan, moving you forward with sage advice and grace.